Okay, very good afternoon to you folks. Welcome to this webinar. I'm Robert Colville, director of thelazytrader.com, and today we'll be discussing how to successfully trade key reversals. And there are a number of different strategy components I want to discuss with you today. But without further ado, I just want to talk to you a little bit about what I can offer you, and just read the terms and conditions first very quickly, the usual stuff. Just a formality, and there we go. But before we make a start in earnest, I just want you to make a note of this this phrase, November 888. You'll find out why after the webinar, but just make a note of it. You'll find that it will make you and save you a lot of money. Anyway, let's get started. So it comes as no surprise that in financial markets trading, you can either trade with the trend and enjoy the predictability that comes with trading with the trend, or you can trade key reversals. Now, it will come as no surprise to you that trading reversals has a pretty low hit rate. 80% of reversals fail, but when you do get it right, you really can make a lot of money. And I'm going to teach you certain ways to get in early to these key reversals so that you can really take advantage and max out with these reversals sooner rather than later. And it's all about identifying potential zones where we can actually find a reversal and anticipate a reversal happening, then waiting for the confirmation of price action, then waiting for the first pullback, by which point you'll be in the position quite handsomely. And we don't get many of these setups per year, but all you need is one or two per year, and that could really look after your trading account for its own. And you'll find that when you start identifying these properly, you won't need to worry about necessarily scanning the markets every day for opportunities for these kind of like bitty pin bar reversals or doji bars. If you can identify a potential turning point in the market and correctly pinpoint a turn and implement the following steps, then this is all you really need for the year, quite frankly. And I'll say from my own experience. So I'm going to really kind of like focus on applying this to real life examples. It's very easy for me just to kind of like twaddle through a load of theory. And but quite frankly, there's no substitute for actually applying this to the charts. So I'm going to do that starting from now. So we'll come back to this slideshow and go straight to the charts here. And I just want to talk to you about the first thing I actually wanted to talk to you about in terms of this process is you need to identify the level, what we call a power zone, a strong horizontal level, which could potentially stop price action going up or going down, a key barrier, suffices to say. And then what we do is look for a price action reversal, and then we look for the pullback. And guess what? We trade all three of these. This strategy can work on any asset class, whether it's a currency pair, a stock, a commodity. You know, I'll show you examples of stocks, and we're watching a few stocks at the moment as well as currency pairs. I mean, this is fully universal, so don't worry. It's not just something you can trade on like cable or euro dollar or anything like that. It's 100% universal. So let's talk about a couple of past examples, and then I'll go and show you my watch list of what is happening in the future. Because, you know, showing you a hindsight example is all very well and good, but it's always very important when it comes to trading to be in the present as well and to be forward-looking. I mean, I can talk to you for weeks about hindsight trades, but will it benefit you? Well, maybe, but it's very important to be in the eye of the storm and in the present and be in sync with what's happening in the market right now. So without further ado, I'm going to talk to you about this key level of resistance this is pound versus the British pound versus the New Zealand dollar. And we've got a decent horizontal level here at a round number. So given this correlation of two factors, we can reasonably say that this is potentially a very good barrier in the way, obscuring price action from going any further up. So what we're going to do is simply anticipate price action turning around at this point. It's a key level of resistance or key ceiling in the way. So what we're going to do is simply place a sell order here And most aggressive traders out there who want to get in to moves pretty much early, then this is what they'll be doing. So we'll place order 1 here, 1% of our trading account of how much we typically risk, and we'll have our stop loss 50 to 100 pips above the level. If you want to be tight, but in this case, I'll say 150 is just fine. So our stop is just around here, and we get triggered into the trade. There we go, triggered into trade number 1. And then we have our price action base set up here. So we're already in off the back of the level here. So as we've got a bearish pin bar reversal, we can move trade 1 to break even. And now, because we've got our bearish pin bar reversal with bearish reversal divergence as well in the RSI, showing that the strength with the bars is getting less and less, what we can do is we can place our order for our second trade just below the low of this bearish pin bar reversal with our stop loss above the high. Remember, we've got our first trade still running, which is at break even. Fantastic. So now what we can do is add to this position and just have an extra 1% or 2%, however much you risk per trade exposed. And there we go. We're triggered into the trade, and there we go. We can just simply write this down, move our stop loss to break even after a second seller bar, and then just anticipate this as a trade which is going to take us to the bottom of the range. If you're somebody who would rather have a higher probability of success or winning trade, but are happy to obviously accept a smaller reward for this, then I would invite you to take profit for both orders you have or both trades you have on this currency pair halfway to the bottom of the range, like so. Okay, but if you're someone who would rather go for a lower probability and anticipate a higher reward by targeting the lower quartile of this range, then of course, by all means, go for it. So it's very personal, this thing, what kind of a trader you are. I'll personally scale out, to be honest with you, and take half my profits off the table halfway down to the bottom of the range here and leave the remaining position going. That's called having the best of both worlds, which is absolutely no bad thing. And, you know, this is just an example of range trades really kind of doing nicely. So if you can imagine, if you'd risk 2% on both trades, your account will be up like a massive amount off the back of this trade. And, you know, this was a very, very simple setup. And just to recap, it was just a simple case of identifying what we call a power zone or a level of strong resistance, placing our order on the level of resistance for a short, having a price action base reversal off this level, moving our first trade to break even, and then placing a second order. In most cases, with these setups, we get a pullback to the 0.618 Fibonacci retracement. We didn't get it this time around, but we took profit halfway down the range and left the remaining position running to the bottom. Some of our clients actually placed the order and completely forgot about it. And ironically, they actually did better than most people. But yeah, you can see that even though it took a while to hit profit target, this is all you really need for the year. I mean, people who took risk 2% on both trades would have made between 20 and 30% return on their trading account if they took it all the way to the bottom of the range here. And I will say as well, to the advantage here is if it was if you have a trading account with a broker, which is obviously direct market access, then you can benefit from the interest rate differentials. So, and Britain at the time, this was back in 2012. Don't worry, there are more recent trade examples, plenty more. But back in 2012, sure enough, there was a big difference between the interest rates in Britain and New Zealand. I believe, well, currently now in New Zealand, the interest rate is 3.5%. Great Britain, it's 0.25, I think. Either way, if we're going short on the pound versus the Kiwi dollar, or the New Zealand dollar, which has a higher interest rate, then that means that we are benefiting from buying the Kiwi or the New Zealand dollar and selling the British pound. So it means that we can benefit every night from the difference or the interest rate differentials and be added a small amount in our brokerage account. Whereas if it was the other way around, we would be losing money. Anyway, suffice it to say, a lot has happened in the market since 2012. I just want to talk to you about a more recent trade, which some of our clients had the initiative to take quite recently. Let me go back to now. Here we go. Is that level 2,100 again? So what happens in the market? What has happened before tends to repeat itself. So you can see here that people have had the foresight of getting and the if you forgive the expression, the testicular fortitude of putting their orders in on this level here in anticipation of a whiplash reaction. Bulls taking this market all the way up to this 1 spot 200, had their stop loss 150 pips away, and before going down, and they got filled in a day of volatility, which is absolutely fine. So they would have been triggered into the trade on the level here, like so. And then they'll be waiting for a price action base setup. Did they get it? Well, no, they didn't get a bearish pin bar reversal. They got an inside seller bar, but that's not really on the radar in terms of our strategies. And then what happened thereafter? They were nicely in profit, by the way, very nicely in profit. Some took profit halfway on this intermediate range here, but others who had slightly more, dare I say, wanted to go for that all-out kind of win. What they were waiting for was a retracement. Typically what happens when we get a key reversal off a level is we get the initial move like we had earlier in, September, late September. Then we had the retracement, and this typically happens at the 0.618 Fibonacci retracement level. And exactly true to form, this is what happened this time round. So when we get a key reversal, even if we don't get a price action to confirm it, as long as we just get the move off the level, get the 0.618 Fibonacci retracement, this would give people who are already short on the level the opportunity to once again add to their position short. So what they'll do is, thanks to the fact we've got a bearish pin bar reversal off the 0.618, they'll place their order just below the low here, a minus spread, minus an extra pip with their stop loss above the high, plus whatever the spread is, plus that additional pip, and take it to wherever they see fit, whether it be the previous swing low or whether it be this level here. I'll just redraw this line. There we go. For a higher probability lower order outcome, or if they're just going to anticipate a long-term short all the way to the bottom here. It's entirely up to them and whatever works for their psychology. Everyone's different. If you're new to trading or newer to trading, I would recommend going for the profile of higher probability and accepting a slightly lower reward for that. It's just better for your psychology. If you, rather than having like loss, big enormous gain, loss, big enormous gain, it's far better, I would say, for your psychology to have maybe a loss and a small gain, loss, small gain. So the frequency of winning trades is a little bit greater, even though they're smaller wins, rather than just having the occasional huge win, but quite a few losses. A lot of people don't like that, and it really does mess with their head, certainly if you're slightly newer to trading. But that said, hopefully if you're new to trading, you are experimenting. When I say experimenting, I say trading with a smaller account to the point where you do not have an emotional attachment on the outcome of a trade. That's not a very good place to be. If you've got an emotional attachment on the outcome of a trade, then you will find yourself essentially burning a lot of your energy up in hope, and you don't want to be in that position at all. Okay, so that's for example, two examples of the pound versus the New Zealand or New Zealand dollar. I've got another example for you as well, because I'm sure that two examples isn't really enough to go through this three-pronged process. There are examples of it happening in recent months, by the way, but I'm just going to start the oldest until the most recent. So here we have, lo and behold, we have this horizontal level for the British pound versus Norwegian krona. And for those people who absolutely shudder at the thought of trading an exotic cross like the pound versus the Norwegian krona, then I'd like to enthusiastically tell you that this currency pair will really behave, ebb and flow like any other currency pair out there. It doesn't matter. We trade it in exactly the same way as we would if it was the British pound versus the US dollar, cable, or Aussie dollar, or a stock, or any other instrument for that matter. It just happens to be the pound versus the Norwegian krona. There's this snobbery going around with a lot of people out there who say, well, I wouldn't even look at that chart, let alone trade it. But actually, when I show you in a minute exactly how we took advantage of trading the pound versus this Norwegian kroner, you'll see quite quickly how it will behave in exactly the same way as any other asset class. Okay, so here we go. We've got this floor here, this level of support, and we've got price with the initial test here, which is fantastic. We didn't actually, admittedly, we didn't actually see it here, price coming down to this point here. It was on the second approach when we saw it. So we had our order on the level here, stop loss below the point where it previously faked out. And then what happened was that we had a bullish pin bar reversal. So that meant what we could do is simply place another order for a long. And we did this, except as it was a false breakout, what we decided to do, instead of taking the break of the high here with our stop loss below the low minus spread minus a pip, we thought that we'd get a far better reward to risk by entering halfway down this bar with our stop loss below the low and essentially doubling our reward to risk. So as we risk 2% per trade, it will mean that for every equivalent distance this will go in our favor, we would make 2%. So we'd bank in 2%, 2%, 2%. And if you see where how far this has actually gone since March last year, you'll see that some of our clients made an enormous gain from this trade. Even the people who actually just walked away and forgot about it completely. So remember, on one hand, we're already in long in this trade, off the level here, like so, and now is our chance to enter the second time round off the back of a price action based reversal, this bullish pin bar reversal here. So we entered, I believe we actually had an inverse head and shoulders on the hourly to give us time frame correlation at the time as well. So we're happily in two positions here. At this point, both were at break even, so we had a very safe trade. And as we can see at this point here, we were at the bottom of, well, it was a trending down market, but we could see that the trend was very, very gradual, and we had a decent amount of upside to take advantage of. I believe a conservative target at the time was around about here at the midpoint, and since then, the pound versus Norwegian krone has done nothing but go up. And you can see that we didn't have our 0.618 retracement. We had a very shallow retracement at the time, so we didn't take it. So we were just in two positions long. But as you can see here, we started our up march, and at this point, those trend-based traders will start to have this on the radar. So there you can see, you can imagine how much profit potential this had. This hit target drastically by June 2013 last year. But since then, as you can see, that this currency pair has done nothing but go up since then. So those people who waited to make a double-digit return in percentage-wise, taking it halfway up to the top of the range here, actually missed out on this higher highs and higher lows. But it's with trading, it's damned if you do, damned if you don't. And the worst possible thing you can do is, if you do exit a position in what might retrospectively seem early, is beat yourself up about it. You fulfilled your rules, and rest assured, those people who are still in this position, who actually did take it back then, who were clients of the lazy trader back then, certainly who have held this position, would have endured quite a few singular losing trades in pursuit of trading that kind of perfect reversal trade. Okay, so that's the pound versus the NOK. Key proof that just because it's an exotic currency pair, it doesn't mean that it's any less good to trade or any less valid to trade than anything else. Okay, so I'm going to talk to you now about one which didn't work out. It's only fair that I give you the balanced scorecard here. I don't want to just talk about my winning trades or our winning trades. It's, you know, it's very important that you see a strategy for its merits and pros and cons, should I say. So here was a recent trade idea we had with the euro versus the NOK, lo and behold, another exotic currency pair, euro versus the NOK. So we had this decent level of resistance in the way, and we were looking to place an order short here off this ceiling in the way of price action coming up or going up further. So we pressed our order on the level, stop loss around about this point here. Sorry, I'm just going to remove all this. There we go. Stop loss was around about here, and we were waiting for price to turn around. We didn't have it. We were immediately ejected out of the market in one hit. So that was the worst case scenario with this trade idea. Sometimes it does require a certain kind of person to actually place their orders on the levels and just simply say, I accept that if I'm wrong, I'm going to lose 2%, but I accept if I'm right and it goes all the way to the bottom, I'm going to potentially make 10%. And this is where reward to risk really does kind of help people psychologically in trading. And if you can rationalize it in your mind, you can simply say, well, it's either going to do one or two things. It's going to turn around at this level here like it has the previous three occasions and go down, or it's going to break upwards. If it breaks upwards, I'm going to lose 1 or 2%, however much you risk per trade. Or if it turns around, I'm potentially going to make between 5 and 10, depending on your target. Okay, so it's like flipping a coin, like a 50 pence or 50 cents coin, and saying, well, 50-50, if it lands on tails, then I lose $20 or $200. If it lands on heads, I make $1,000. It's one of those things. And this is why the reward to risk tends to really always carry us through in kind of like 50-50 potential outcomes like this. Okay, so that was the Euro knock. That was an example of a trade which didn't work out at all. A recent one I'd like to add. And now let's move on to the FTSE. This is one which is quite interesting. We had back in September, well, certainly in the UK, we had this whole hullabaloo about Scotland getting their independence and, all this kind of commotion about Alex Salmond and the leaked results of this, or not even leaked results, sorry, the results of this shock poll 2 weeks before the referendum that Scotland, the No campaign, had lost momentum and the Yes vote for independence were ahead. So, of course, the FTSE, we had already rationalised in our minds with this trade that, okay, we're already short FTSE off the back of this level here. It's the penultimate high. This ceiling in the way of price action has been respected on numerous occasions, I think about 9 occasions, since the all-time high last tested in 2000 in the dot-com boom. So we kind of said to ourselves, look, well, face it, it's quite likely it's going to ricochet off this level, just like it has before. And lo and behold, it did. And we're already in short. We had a price action base set up here. Also to add to our position. So let me recap. We placed an order short on the level here. Great. We had the false breakout as we were expecting, and we're already on the level, but now we have a price action base setup. So what we can do is add to our position here. The price action base setup with the close just below the level here adds weight to this position or our position. The argument that it's going to go down, and then we had price messing around after that. It was like a yo-yo effect. We had like one camp saying that the Yes vote were going to win for Scottish independence, and on the other hand, no. But did we care about that? Not really. We knew that the worst possible thing that can happen is that we would lose between 2 to 4%, depending on whether we risked 1 or 2% per trade here on the price action based setup and the horizontal level. And we knew that we had a good amount to make if we were right, if we were targeting the previous level here, or even the midpoint. So this is what happened. Price just carried on. We had the retest, this bearish pin bar reversal, which of course correlated with the 0.618. And for those people who are still in the trade, those people who obviously had great belief in their trade and were not watching their charts and were not listening to the news and didn't really care about what Alex Salmond was saying or thinking. Well, I never did, to be honest with you. But they would have placed their orders on this entry just below the low here, minus spread minus a point, with their stop loss above the high, plus spread plus a point, and let it fall thereafter. Okay, so, and this is what happened. Okay, a lot of people took profit at the halfway point here. Some people took it all the way at the bottom, but most people will take it psychologically more predisposed to take it at the halfway point for that higher probability. So that was the FTSE. Okay, so I'm just going to talk to you now about some current setups. I'm going to talk to you, if you forgive me. I'm actually looking at doing this on a stock, just Very short recap though, because I'm sure some of you might have a few questions. Somebody asked actually, FX Boyke, what percentage are you fundamental and technical? Well, I would say I look at this 100% technically. Okay. I just wanted to give you a bit of context as to what was going in the market when I was talking about the FTSE and the Scottish referendum. So, even though Scotland voted no to independence, you can see that the FTSE even went down anyway, even though that everyone, well, the market like that, dread to think what the cable and the FTSE would have done had the yes vote won and Scotland would have got their independence. But you can see that even in the face of yes, the no camp winning and Scotland remaining a part of the Union, the FTSE still went down anyway. So I would always say trade what you see, not what you think. It's very important to do that when you're looking at major reversals. Of course, it's always good to have context on your side. And I'll talk about context a little bit later on with the watch list, which I'm going to bring to your attention. But I just want to bring this to your attention. Now it's British Petroleum. I'm just going to quickly talk to you about a stock. I know this is a Forex webinar, but please just close your eyes and imagine that this is a stock. Sorry, a currency pair, my apologies. There we go, British Petroleum. Here we go. So, as you can see here, we've seen this stock range-bound ever since I really care to remember, ever since that debacle with that big oil spill they had close to the United States. It's been ranging ever since. Irrespective of the news, we can certainly agree on the fact that this is a significant flaw here, as is this one here. So, on one hand, we had a level here for people to have an order for a long on. Admittedly, I didn't spot this until over the weekend, so I didn't have an order on long. If I had on the level, I'd have been stopped out for a loss. However, the low test would have given me, enormous low test would have given me an opportunity to get in long. And this high low here of a 0.618 Fibonacci retracement has given me a potential second entry for a long here. As you can see, the great thing about this is that not only are we at the bottom of a well-established range here, and it makes logical sense to simply buy the bottom of the range and to sell the top until there's a breakout, and if there is a breakout, then it's invalid, the whole range, which it's not, and it hasn't been for quite some time, for years, then I'll be inclined to simply carry on buying the bottom and selling the top. In this case, as the FTSE is in a bit of a bull run and we're approaching, well, within weeks, a Santa Claus rally, then I'll be inclined to go with that. And I can see, even though a lot of people, including Warren Buffett, think that equities are overextended, and the Warren Buffett indicator is flashing for a crash. You know what? They were saying this months ago as well. So we're inclined to go with the trend. And what better time is there to buy the FTSE or equities than Christmas, when seasonally it's extremely, extremely bullish, and they call it the Santa Claus rally for a reason. I'll be more inclined to look for shorts on equities and certainly the FTSE and the Dow in the new year. We will look at the January effects and how January closes and gives us perspective for the rest of the year. But that's a whole different conversation for a different day. So let's just quickly talk about what's upcoming on the watch list. We're quickly, rapidly going through time. And I feel that we've covered a lot in a very short space of time, and you've been very good. All the questions you've been asking have been very good, albeit just the one. So just to recap, what I want to identify here to trading reversals and scaling it early to big reversals for high profit potential is, first of all, identify a key level of support or resistance, the kind of level which has remained intact for well over a year or more, and has tested at least once within the year. Identify after we've been triggered in to the trade. Identify a price action based reversal. Typically these are bearish or bullish pin bar reversals, depending on whether you're long or short. And then we need to wait. This might not happen for Fibonacci retracement of the 0.618. And as I said, these are have the potential to be extremely profitable, and you don't really need to be looking at the charts every day, every week even, in order to identify them. It's the most easy way of trading for someone like me. Who is the lazy trader after all. In answer to your questions, I would say that this is traded on the daily exclusively, or the weekly. I'm not really interested in trading this on any smaller time frame. The reason why is because it's a question of opportunity flow. I know that I can get perspective on this, even if I'm looking at the charts every other day or every other week on the daily or weekly time frame. But if I am going out and doing my own thing, which is what I like to do, and not be chained to the desk or the charts, then certainly if I'm trading the hourly, then I would obviously there would be an element of having to be in front of the screen. And that's the problem, really. How do you enter? How do you use indicators? Well, I'll address your questions towards the end if that's okay. Got a little bit more to go through. I mean, feel free to ask me a question whenever, but I will answer them at the end. So hopefully we have a deal there. I'm just going to show you now what is on the watch list, and I'm going to show you, lo and behold, what was on the watch list for this actually earlier in the year was Aussie versus the New Zealand dollar. We can see that they are actually at a 25-year low here, all-time low as well. So you can see this range here. You can see the perspective on it on the weekly time frame here. So as you can probably imagine, it makes sense to buy the bottom and to sell the top. And it's taken about 4 years for it to go all the way to the all-time high for Aussie versus New Zealand to go to the all-time low. So it makes sense to really take advantage of this and buy it at the bottom. So what we could see here, even though it might be a little bit late in the day, we could see a major W-shaped formation on the weekly. And certainly if price did get down to this level again, then I'll be looking to buy the Aussie versus New Zealand on the level. Then I'll wait for a price action based reversal bar on the daily, preferably, because it will mean I can get a much smaller distance between my entry and my stop loss. And then I'll wait for price to extend upwards and then retrace 0.618 Fibonacci retracement. So that's on the watch list. Funnily enough, actually, a lot of my Aussie-based pairs are on the watch list. I'm going to talk to you about Aussie Swiss on the daily, I believe. Yep, there we are. We can see we've got a decent level here, 0.8721. We have here. So lo and behold, this is a level which hasn't been broken for over a year. So I'm just going to simply have an order to sell on the level. I'd rather use a future-based contract here, because if I'm shorting the Aussie dollar which has a higher interest attached to it, 3.5% versus the Swiss franc, which has a smaller, I believe, if my memory serves me correctly. It means that if it's a cash daily rolling order, I'll be penalised from going short on the currency with the smallest interest rate. So I'd recommend a futures contract if you're to trade this over a long period of time, that is. So just to recap, I'll place an order on the horizontal level here in anticipation of price ricocheting off it again. Then I'd wait for a price action based setup in the form of a bearish pin bar reversal or even a doji bar at the level. And then I'll add to the position by placing the orders. And then I'll just simply wait for the market to do its thing and go down. And then a 0.618 Fibonacci retracement, which is just the first lower high before we get the move downwards into the middle of the range here. And we can see here that we are range bound. No real mistake about it. So it makes sense here to simply sell the top of the range and to buy the bottom. Nothing particularly overtly complicated about this at all. I'll just simply say, look, on the higher time frames, on all the currencies, the majors, minors, exotics, whether it's the monthly or the weekly, you'll notice down a lot of the crosses, for example. Now, even let's have a look at Aussie yen, for example. On the monthly, we can see that a lot of these crosses haven't done anything but range for the past 25 years. So a lot's happened in 25 years' time. We've had booms and busts. So, essentially a currency pair, trading long or short on the base currency pair, you're speculating on a two-horse race between two countries. So lo and behold, I would be waiting for a short here as and when the Aussie dollar gets up against the yen to 107.75. And but in the meantime, I'll be waiting for longs because it would be a good carry trade to have going long on the Aussie dollar versus the yen because of the interest rate differentials. So you can see that I've identified my key levels early, and all I have to do is really set an alert or an alarm so that I can just get informed that price is coming close to this level. If I haven't already placed my orders on it, say if I'm in the gym or I'm on holiday or somewhere else, out and about, creating mischief on the streets of London, then I would simply have an alert and my orders already set up on the level, and then simply I would wait for a price action based setup of the level, and then that initial 0.618 retracement before continuation along to the downside. And even if you ignore a lot of what I've said today and just simply go away with that logic of a well-established range, sell the top of the range and buy the bottom, then you could do a lot worse than that. And you could do that on any time frame, by the way, whether it's the daily, weekly, or hourly. It's not rocket science at all. But what you'll need for this is patience and discipline. Those two chestnuts. I'm sure you've had that before, but guess what? I will shout it from the rooftops again and again, because this is the one thing which we cannot really kind of install into you apart from reminding you every time. The market will be a great mentor if you stray away from being patient and disciplined through the punishing you from robbing your trading account of money whenever you do stray away from being patient and disciplined and trading for the sake of trading. Okay, so moving slightly on, we've talked about building a position and trading key reversals. So you have essentially have traded two different strategies based on supply and demand, i.e. an order placed on the horizontal level, then you'll have traded a price action based setup when the move is a little bit more confirmed, and then you trade the third on the pullback. We've given you some examples. Pound versus New Zealand twice for a sell, British pound versus the Norwegian kroner for a long back last year, FTSE for a short, and British Petroleum Current. As I said to you earlier, please do, you wrote down a certain code. Well, this is for something I'd like to bring to your attention. TheLazyTrader.com specializes in teaching you how to trade financial markets from as little as 10 minutes a day. All of our strategies are very much set and forget. But as you've bothered to come to the webinar today and you've taken time out, it says to me that you are relatively serious in expanding your mind and becoming consistent traders. And I like to help people like your good self. So what I'm doing is we do run a mentoring program, our flagship mentoring program, valued at $1,997, which basically has everything in it from our strategies, market analysis, trade ideas, even trader hypnosis, which is cutting edge. Then you can get it for $97, but it's only available for tonight, until tonight. If you type in the promo code November 888. So to do that, just go to thelazytrader.com, go and buy the ultimate program, use the promo code November 888, and you'll save yourself a stack of cash. And certainly this mentorship really does help you every step of the way in terms of mentoring you long-term, giving you trade ideas, strategies, in addition to numerous bonuses. And of course, if you're not happy, we'll just give you a full refund. We'd want you to be happy. If you're not, we'll just give you your money back, no problem. We'd rather have satisfied customers, even rather than dissatisfied customers, obviously. So check it out. No love lost if you don't, but we've had a great success rate in obviously making people profitable and happy as a result. In terms of your questions for the seminar, let's have a look here. Do you enter, how do you use indicators? Well, I think a good question, but I think we can, I'm going to have to do another webinar, on indicators. I can't really answer that one within a few minutes, but I would say I don't use indicators if I'm trading purely off levels of support and resistance, but I would if I'm looking to trade price action on its own. Do I like trends? Good question. This is from FX Boyke. I do like trends, but quite frankly, I find reversals a lot more profitable when you really do hit the nail on the head. But I do like trends as well. But I know that quite frankly, trends are very good if you want smaller rewards and more frequent rewards. I'd far rather just set my trades up and walk away, and I can really do that to maximum effect when I'm trading reversals and range-based markets. And you can get range-based markets on daily and weekly timeframes on pretty much any currency pair asset class out there. Okay, so any more questions? Do feel free to ask. I do this on the daily, but there's nothing to stop you doing this on any smaller time frame. The reason why I do trade this on the daily time frame is because it's stable and immune to a lot of news announcements out there. It means that we don't get pinged out and intraday noise basically pinging us out of the trade before running to profit, which would happen if we're trading a smaller time frame. Okay, so to those of you who hopefully see you on board, the Lazy Trader Ultimate Program will give you a golden handshake, and we've got some special software as well, which will automatically seek price action based setups for you. But certainly only for tonight, it's for $97, providing you use this promotion code November 888. And yeah, hope to see you on board. No love lost if not, but you know, it's pretty much the best you'll get. We won't get any cheaper than that. And then the price will revert back to its normal fee, which is a lot more. So any more questions? Okay, well, if there are no more questions, I'm very happy to call it a day. If there are, feel free to just open the chat window and publish them in there. And I will answer. But please rest assured that what I've just described to you can work on any asset class, really. The great thing about Forex, of course, is that it doesn't gap all the time like stocks has a tendency to do. And it's more of a level playing field. The currency markets aren't really as susceptible to manipulation like stocks can be. And that's it, really. So have a look on your weekly and monthly charts, and you'll be able to see these big potential setups with long-term potential. Okay. Anyway, that's it from me. Happy trading. Good luck and take care.